All right, let's talk about one of the most audacious corporate frauds in history. I'm talking about a company that built a multi-billion-dollar empire on, well, basically on an illusion. That company was Enron.
Just let this number sink in for a second. $63 billion. Back in the year 2000, that was the market value of Enron. We're talking about the seventh largest company in America. They were a titan, a symbol of new economy innovation. Everyone thought they were absolutely unstoppable.
And then, poof, almost overnight, it was all gone. That entire $63 billion valuation just evaporated, taking the life savings of thousands of employees and investors right along with it.
So that's the central mystery here, right? How did a company that was so massive, so admired, turn out to be completely hollow inside? It's a crazy story. And to understand the collapse, you first have to understand the powerful illusion they built.
Okay, so let's start with what the world thought Enron was. Because believe it or not, they didn't start out as some flashy Wall Street darling. Nope, their beginnings were actually pretty boring. So you go back to 1985, and Enron is just this, a simple gas pipeline company. But then the 90s hit, and they completely reinvented themselves. They became an energy bank, trading everything you could imagine, from electricity to internet bandwidth. By August of 2000, their stock was just soaring, and everyone was hailing them as pioneers.
Oh yeah, the press absolutely loved them. They had this great nickname, Silicon Valley with a cowboy hat. Brilliant, aggressive, the future of American business. And that was the story they were selling. But behind that incredible story, two massive deceptions were at play. So let's break down the first one.
This right here is where the financial fiction really begins. See, Enron needed to look like it was constantly making more and more money to keep that stock price high. And to do that, they used an accounting method that was frankly more like a magic trick.
It's called mark-to-market accounting, and this is where things get absolutely wild. Essentially, the moment Enron signed, say, a 20-year deal, it could claim all 20 years of projected profits as real income on that very day.
So look at this comparison. Most companies, normal companies, book revenue when the cash actually arrives. Simple, right? Enron, on the other hand, was booking revenue based on optimistic guesses about the future. They were literally counting chickens decades before they hatched. But of course, that created another problem. What do you do with all your real-world failures and all your real...
And that brings us to the second pillar of the fraud. Because if you're inventing profits out of thin air, you also need a way to hide your losses. And believe me, Enron had billions in debt from failed ventures. Their solution was, well, it was brilliantly deceptive.
They used something called a special purpose entity, or an SPE. The best way to think about it is like a financial black hole. Enron would create these complicated, separate shell companies designed for one purpose and one purpose only: to absorb Enron's debt and make it disappear from the main company's books.
Here's how the shell game worked. Enron had a bad asset or a failed deal. They'd set up an SPE, often run by one of their own executives, which is just crazy, and then sell the bad debt to the shell company. Poof. To investors looking at the official books, the debt was simply gone.
And this famous quote from the former CEO, Jeffrey Skilling, really captures the culture. "I'm not an accountant," he said. The top executives maintained this plausible deniability, staying above all the messy details, all while this complex web of partnerships was busy writing a blockbuster story of success.
So you've got fake profits on one side and hidden debt on the other. This created a perfect illusion of success, but it was incredibly fragile. It was a total house of cards, and it was about to come tumbling down.
The whole system was just so fragile, it depended entirely on trust and a constantly rising stock price. Because remember, the fake profits weren't real cash, and the hidden debt was still there, eating away at the foundation. So the second a few journalists and analysts started questioning the story, the entire fiction just began to crack.
And just look at the result. The collapse was breathtakingly fast. In just over a year, the stock went from more than $90 a share to less than $1, just 26 cents. The confidence that had propped up the entire fiction was completely gone.
And that was it. The story was over. On December 2nd, 2001, Enron, the seventh largest company in America, filed for bankruptcy. But the story's impact was just beginning.
Yeah, the collapse was really just the beginning of the next chapter. The fallout from this one company's fraud didn't just ripple through the market. It changed the rules of corporate America forever.
The scandal led directly to the Sarbanes-Oxley Act, a sweeping piece of legislation to prevent this kind of fraud from happening again. It destroyed Arthur Andersen, Enron's accounting firm, which at the time was one of the big five in the world. And maybe most importantly, it just shattered the public's trust in corporate financial reporting.
Ultimately, the Enron affair is such a powerful lesson in the danger of financial storytelling. For years, the narrative Enron sold, the story of unstoppable innovation and endless growth, was simply more powerful to investors than the complicated, ugly reality that was hidden in their books.
The specific accounting loopholes Enron used were closed, but it leaves you with a big question, doesn't it? The basic impulse to craft a compelling narrative, to tell a story that might be a little more optimistic than the numbers suggest. Has that ever really gone away?